All right, so we're going to talk about premium decay today. So theoretically, in at-the-money options, premium decay looks like this, accelerating in the last 50 days. But basically, when you're looking at premium decay, it's not a linear curve. When you look further out in time, it's a lot slower decay. As you get to that 40 to 50-day time frame, premium decay starts to accelerate as you get closer to expiration. Of course, there is a point of risk reward baked into this. Of course, you have faster decay as you get closer to expiration, but that comes with a lot more risk versus something that's 40 or 50 days out in time. Does this hold true in real trading? To test this, we need to separate the occurrences with and without directional movement. If the current stock price is close enough to the original stock price, then we can say the position's P&L is purely from premium time decay. So we're isolating the stock movement and the delta exposure that you get from short premium, and we're just looking at the data decay relative to sideways moves in the market. So getting to the next slide, we're looking at SPY. We're doing 2005 to present. We sold the at-the-money puts at a 50 delta. We recorded only the non-movement occurrences. So we're looking at the time where the stock, in this case SPY, was within 0.5% of the price on the previous day. So it's basically looking at quote unquote non-movements or inside moves in the market. So first, we're going to take a look at the distribution of non-movement occurrences in the 45-day to expiration cycles. And when we jump to the next one here, as expected, the longer duration, the lower the probability of the stock price coming back to.
Right, well, they're just talking about like expected moves. So if something moves $30 and it has a $3 expected move over a 6-month period of time, it's going to take it a lot longer to get back that price, even if it goes all in one direction. But now remember, from a volatility standpoint, you're talking more about being a lot more mean reverting. Now, we're not talking about volatility here, just talking about stock price itself.
Yes.
A lot of times people get to smoke hopium, and since we had this large move to the downside or to the upside so quickly, that once it backs off, it certainly can go baback there again. And again, it is a 50-50 shot on direction, but it's all about the implied volatility for an expected move, which is 100% correct 68% of the time.
That's good. Yeah, you had to add that one in. That was good. Jump into the next slide. So next, we isolate these non-movement occurrences to test how closely the actual daily premium decay matches the theoretical premium decay. So this will get closer to that original slide. The first slide, that was a non-scientific slide. We're going to look at the actual curve of the realized premium decay. We'll jump to slide 7 here. So the curve of realized premium decay looks very close to the theoretical one, with the acceleration in decay approaching expiration. So as you get closer to expiration, of course, you're going to have faster premium decay. You only have a certain amount of time, especially when you're looking at these closer at-the-money options. This goes to the other slide of mean reversion of price being much closer on a day-to-day basis, or on a shorter duration, because it's more of a 50-50 shot versus a longer duration where you don't have that same sort of coin flip. We have known that obviously in the bull markets in the past years, tested the call side more often than the put side. If we control for the directional bias, does the call premium decay look similar to the put premium decay? And so again, we're looking at these sideways moves versus, a long period of time where we're only, we're looking at the total directional move. This whole study is looking at just those like inside move periods of time and days. So the actual premium decay for calls matches the put premium decay in the hypothetical curve. So again, when you take the directional move out of the equation, the decay on calls and puts are relatively the same as the takeaway.
Yes.
Here.
Yes. Agreed.
Takeaways here: delta is one of the largest risks when trading and can adversely impact traded performance. And this again goes to what we were just talking about here. We took delta out of the equation for this study and just looked at premium decay and tried to kind of compare calls versus puts. Delta, of course, has been the biggest issue for positions over this period of time. When we control for delta, the changes in the underlying price, we clearly see where our returns come from. They come from premium decay. That's why we're always talking about looking at high volatility and mean reversion of volatility. Theoretical premium decay very closely matches actual premium decay. Since most traders sell out of money options, does actual out of the money option decay also follow the theoretical? That will be covered in part 2.
Ooh. Part 2 looming. Went through that pretty quickly. Really, it was just about price movement, right? I mean, you're looking at probability of pop on an expected move. That's really what